One day you might be making 10 million, then you might be losing 20 million.
Markouts are now a widely available tool, right?
Your client is Chinese, but they are trading from London, okay, using a VPS or whatever. So again, you also need to factor in.
What do you see are the hottest trends then in our industry, not just in liquidity or risk management? Welcome to the Your Bourse podcast, where industry insight meets strategies to grow your bottom line. I'm Elina Pedersen, co-founder of Your Bourse, delivering the fastest matching engine in retail FX and CFDs. Today, we're diving into liquidity provision, risk management, trading on your own account, and much more. Joining me is Marios Antoniou, CEO of LP Prime, a fresh liquidity startup quickly gaining popularity across smaller and medium-sized brokers alike, offering access to over 1,350 trading instruments. Welcome, Marios.
Hello, Elina. Nice to be here. That was quite an introduction.
Yeah, I tried. I hope I didn't make any mistakes. So, Marius, please tell us a little bit about yourself. How did you get into the financial industry? How did it all started?
Oh, I feel like an old man right now. Yeah, it all started back in 2010 when I was still a student back in Thessaloniki. The funny thing is that my father once asked me to open an account with a company. I don't even remember their name now. Try a demo account. Then we opted in for a live account. So fast forward in 2014, when I finished my studies, I came back to Cyprus. I got my first job with Iron FX at Iron FX, which was quite the journey. Was it was another university for me. We saw a lot of things, learned many things when it comes to dealing. Then I led for a short period of time the dealing desk of TopFX, another liquidity provider. Then I moved to Hellenic Bank. I was part of the liquidity market and interest rate risk of the bank, of the overall risk management division. Then I decided that that's not the right path for me, at least in terms of culture, etc. So I took the step back in the CFT industry. I joined EverFX. I stayed, if I'm not mistaken, for 4 years there. Then again, I decided that, let me try something else. So I joined the Delta Mark, which was an alternative investment fund manager. As a risk manager, we had a lot of funds under management. Then again, I said that, okay, I really like CFD, so I'm going back, and here we are at Prime.
You know, the interesting part is that the brightest people I know, first of all, we've all started with trading. We all tried it. I was speaking to Luke at one of the podcasts from a Trade Locker, and it was like, we all done it.
Yeah,
That's
yeah,
one
yeah.
thing. And the second thing is like, we all at some point left FX and CFDs, and then we came back because, it's so dynamic. There is probably nothing like it anywhere else.
It's like I feel like a junkie, a CFD junkie. I don't know.
A little bit. Okay, I know from. I mean, I've met you before for a while now, so I know that you did not just manage dealing desks of brokerages, but you also managed the dealing on own account departments. How is
Mhm.
that different within a broker or in other organizations?
So first of all, each organization is different. Okay, you understand that different pockets, different sizes, different appetites, and different approach. When you have the ability to absorb losses, then things are much easier compared to a broker that doesn't have this ability. Now, the main concept though is the same. It's all about mathematics. Okay, and probability. So, and broker essentially is the house. People are trading against, wouldn't say against the house. They trade in an environment where the probabilities are against them, given they pay the spread. So you have to be patient in times when the market does not have a direction, but it stays within ranges. Now, when you have the ability to absorb the losses, that's fine. When you don't, then you also need to take a much more dynamic approach, locking profits when you have to be less be more risk averse actually when you've hit your limits. But one thing that's become clear across the years is that you have to have a clear message coming from the board to the dealing desk, meaning that once you've created the line of defenses, first, second line of and third line of defense, as per the risk management frameworks, then you need to have clear instructions to them. You need to give them their limits, and they have to stick to them, and also somebody needs to oversee them, right? As long as they stay within the rules, within the appetite that the company has, everything should be okay.
So it's all about risk appetite and, in a way, exposure hedging, or brokers' risk appetite and exposure hedging and risk management, right? So that's what the
Yeah,
dealing on its own account does.
yeah. Dealing desk is the first line of defense, but they have to follow the limits imposed by the board, right?
Of course. I love it. I love it when the CEOs of a company actually have dealing experience because then it's so like the logic is so much more connected as to, what the financial firm is in a way. So tell us please about LP Prime. I know it's quite fresh. It's been what, year and a half now, maybe?
Yeah.
Okay, so how was it created? What is it about? How is it different?
So it was an idea that my partner and I had earlier, no, late 2024. So the main idea here is that we excel at support. Okay, so first of all, we think that all clients deserve equal treatment. So we create dedicated channels with them. We have somebody monitoring everything 24/5. So whatever they need, we are fast responding. We are fast responders. The also the other thing that we wanted to do was to come up with a solution that is flexible and can be tailored to the customer's needs. Okay, so instead of having one solution and it's either take it or leave it, we sit with the client, understand their needs, and create a feed and an environment that is suitable for them. And what you see is what we get. This is the very important for us. So the execution should be good. It is good. The quality of the feed should be good. It is good. How we support you. We are very good at it. So it's a combination of things that we saw missing from the market that we said, okay, let's fill this gap and try to onboard new clients. Now, this solution is suitable, I mean, to small brokers, to big brokers. We have this ability now to onboard pretty much anyone because before launching the project, we managed to establish a relationship with tier one providers. So as we are ready before launching the product to onboard anything.
I did notice that you managed to headhunt some of the best people in the industry for sure, especially when you started. And then, the news came out, oh, I've joined NLP Prime, I've joined NLP Prime. I was like, oh, these are like actually people that I would like to have. So you definitely have a lot of talent in your company.
Yeah.
So I'm just going to ask you about risk management for brokers, if you don't mind. And these are like more general questions for our audience because our audience is pretty much business owners, and a lot of it is also dealing desk. Some of the brokers are smaller, some of the brokers are larger, as you know, and especially that it's your strongest suit as a broker. I was wondering, like, if you would be giving advice to a broker, what kind of metrics or indicators would you say they need to monitor on daily basis?
So the most important indicator for me is the revenue per million traded on Pedersen. Okay, so again, as I said before, everything's about mathematics. The way that you approach dealing desk is purely probabilistic. So if you charge 2 pips and the execution is fair, then you should be expected to make 2 pips as revenue when trades come in, plus swaps, commissions, or whatever. Or anything else that the broker might be charging. So you need to have a really good look at it. Now, when you see that the numbers deviate from the norm, you need to have a look. So there must be something that disturbs the tradings, or there must be somebody toxic within the flow, or the conditions that you have provided your clients with are not realistic ones. Okay, so let's say you gave sub free to clients and high degree of leverage, then most probably your margins will be very small. Another metric that you need to have a look at is the volume generated by the equity that you have. So let's say if you have people depositing money in their account, but they are not actively trading with it, and by trading I don't mean utilize their leverage, but I mean generate volumes, then essentially you won't be making money. So you need to find a way to retain also the volumes. Again, the brokers are the houses. For them to generate income, they need trading activity. To generate the trading activity, you need to somehow, under a compliant way, okay, by complying to the relevant directives, generate trading volumes. Another thing that I would have a look at is how diverse the portfolio is in terms of where the money comes from, and the instruments that our clients trade with. So if you have concentration risk, either in one country, either in a specific symbol, then again, the project is not going to survive for long, right? So you need to offer a lot of instruments, and you need to have people trade with them to create a diverse portfolio that can be easily managed. Now, if you have people, let's say that has been the trend for the past month now, trading gold, long gold only, and they are
Yeah,
swap
one
free, then
directional gold. That was my next
yeah.
question.
Then you understand there is not much that you can do. So you need diversification. You need volumes. You need to check constantly how much do I charge? How much do I get? Does it fall under the normal distribution? Yes or no? No. Why? Yes. Then something is good. So these are metrics that you need to keep up with constantly, and also the expenses. And I don't mean the fixed expenses. I mean, if you run an IB business, you need to know that, okay, if the spread is X, I pay the IB Y. Y must be significantly less than X, all right? Because you also need to factor in that the need to hedge might arise at some point, right? So you also pay spreads to your liquidity providers on top of other expenses that you might have. So you also need to factor in those components in the equation. And then there's also the infrastructure, right? Where is my server located? Where do I have the proxies? Is it cloud? Is it physical machine? Is it cross-connected with my LPs? Do my clients have the ability to ARP my feed? If so, how do they do it? I don't know. I can keep going on the
I
with
know,
the
I
things
know.
that.
But so yeah, thank you for this. And I think this is one of the things that we come back to often, that profitability is a function of spread. But I'm just wondering, like, is there a way, or do you at LP Prime benchmark it somehow? Of course, yes, it's your spread. It's the pretty much what you're charging. But is there a good benchmark as to how certain traders deviate from the standard, I don't want to say distribution, but like a standard profile?
That's a good question. You understand that as LP Prime, we offer liquidity to brokers, meaning that the majority of the flow that we received, it's either flow that has exceeded the limits that the broker has set internally, or it's a flow that has already been filtered. So you need a very large number of trades for it to see it being normalized, right? So the good thing is that we see a lot of different strategies being applied by different brokers, but also the very same strategies being applied by very different brokers. So especially when it comes to, and don't like using the term toxic, but just for simplicity, let's when it comes to toxic flow, for example, you can see that the same trades come from, I don't know, 10 brokers at the same time.
So it's the
Them,
same clients, right? Ultimately, that they're dealing with.
yes, essentially, yes. Essentially, yes. Now, as a broker, they might not understand that this is not a regular flow, but us seeing all this flow coming to us, and sometimes they might be hedged. So once they've realized, once they have a floating point, for example, they might hedge from different brokers just to move profits from one broker to another. So they might not understand, but us having a bigger picture compared to them, we can spot the patterns. Now, the profile of the individual traders, unfortunately, we don't have it, but we can see specific patterns. Again, to normalize and LP Prime being like a retail broker, we need a lot of trades for it to be normalized, given that the flow is filtered, right?
So, so obviously, as you said, the brokers very often already derive the value from the flow before they're able to send it to you, right? So, and you need to somehow normalize it to make money out of it, I assume. So what do you think is like a healthy mix for a broker? Like how much should they hedge and what should they hedge? Should they just send you the flow that is already derived the value? How does that relationship work then? So what's the strategy for a broker? Should they hedge a lot? Should they keep it in-house?
The first thing that they need to do is to understand mathematics.
Okay.
I would say that given that the probabilities are in favor of the house, they can internalize much of the flow. The most important thing, though, is to set the limit. Okay, because the profitability comes in variations, right? One day you might be making 10 million, then you might be losing 20 million, etc. So it's not a straight line or a linear line that is gonna be is gonna reveal itself, right? So once you've established your internal limits, then stick to that rule. Okay, so there are brokers that might not have risk appetite to be book. So in that scenario, they should hedge fully their exposure. There are brokers that they have some appetite, so they might be hedging a portion of their exposure. But I would suggest taking an approach that instead of hedging individual traders, it would be better if you were to hedge portion of your exposure, right? Because imagine having a trade that is long 10 lots on gold, for example, and a client being short 5 lots. Then the net exposure is 5 lots. Okay, because they hedge themselves internally, partially at least. So take a portion of that remaining 5 lots and hedge it. You don't have the appetite to absorb the whole exposure. So always you need to see the portfolio as its whole before deciding to hedge and what to hedge. Also, take into consideration the correlation across the instruments, right? You have gold and silver, Brent, WTI, or I don't know, the indices. You have products that are correlated. So absorbing one, hedging fully the other does not really solve the problem. There are a lot of systems that can generate the correlations, and then also you can partially hedge certain degree of your exposure. Also, if you have Euro Yen and USD Yen, then you can hedge on Euro USD, for example. Depends on how the exposures are. So first, define your appetite, define your limits, and then the approach will come. But it's also good to have a liquidity provider to offload part of your risk and at least to have a business in the following day, right? Because black swans can happen anytime.
So yeah, totally agree. And when those clients, so I think it's a bit, it's as you've described it, the way dealing that, or your book being really an ecosystem in the way, I guess you choose your clients as much as they choose you, in a way that you need to make sure that they fit whenever you speak to a client, that they fit in a certain parameters that would benefit your other clients, your whole book? Or is it more of like, we can manage pretty much anything and we'll just figure it out?
We don't pick the clients, but we take a realistic approach. So the solution that we are gonna offer to the client, it's gonna be a solution that first of all will give us the ability to hedge if and when we need to. Okay, that's very important for us. So if there is an element in the offering that prevents us from hedging, then it's a no-go. Okay, because we are not
Yeah.
going to risk. First of all, for the relationship, it's gonna be a bad thing, right? Imagine onboarding a client only to tell them in 5, 6 months, listen, we cannot serve you anymore, right? It's not nice. And so the way that we approach things is come, tell us what you need. Okay, if we can do it, we are going to do it. It won't affect, we won't take into consideration the rest of the portfolio, but we need to have the ability to manage the risk arising from our relationship, right? So as long as there is something that can be done, it will be done.
Okay. So when those clients, before they of course send you the flow, when they look at their own book, what would be your advice in terms of identifying sharp flow, and how did you identify sharp flow? Like maybe there are 5 indicators that you look at, or what would be like your your way of classifying it?
Okay, sharp flow is a very generic term. You can have one leg arbitrage, two leg arbitrage, you might have volatility arbitrage, people that move the market. We've seen that happening. So the most relevant metric to take into consideration is the markouts. Okay, so imagine the price follows the normal distribution. So a new code is independent from the previous code, but 65% should be the same price and 35% should be equal distributed up or down, right? So once a trade comes in and you check the markouts, you expect and in the next two or three codes for that trade not to be positive, right?
Okay. Yep.
Eventually it might become positive. That's
Yep.
not a
Yep.
problem. But for the next two, three, 10 codes, it should not be positive. So you take into consideration the markup. How long does the client need in order to become positive? And then how much positive? Okay, so is this something that is normal? Does it happen once every 10 trades? Does it happen 8 every 10 trades? You need to also have a look at it. Also, when do they place trades? Do they place trades during liquid hours? Do they place trades when there is a spike? Do they place trades where around the news? When? And also from where? Now, let's say that you have an MT5 server. So the server is located in London. Your client is Chinese, but they are trading from London. Okay, using a VPS or whatever. So again, you also need to factor it. And after having 3 or 5 confirmation that something is wrong with this flow, then you need to take an action. Now, that does not mean that you are going to remove the profit, decide not to pay the client, and they will see you around. No, you need to check whether there is a solution for this client to stay with you. If not, just terminate the business. So far, we haven't had any issues, whatever the strategy, but there are many things that you have to factor in, right? So also there is a way to hide how you really trade, because you might be using an EA, but MT4, MT5 might show that this is a mobile or this is a terminal. Again, you can check the logins. Do they trade from an actual mobile machine, or do they trade from a computer and they are checking their trades from a mobile? So again, all these are listed in the journal of MT4, MT5, and you can decide whether this is sharp or not. But it's a time, how frequent, when. All these are summed up in the Markouts report.
To be honest, I was just saying that about a week ago. I'm so glad to hear that markouts are now a widely available tool, right? Because I think 15 years back, only banks were using it and the brokers had not a lot of understanding of how it works. And now it is available in like technologies such as your Bourse. Also, by the way, regarding the tracking the nature of the trade, I think it's incredibly important. I think more and more brokers are looking into it. We had to change how we can set up hedging multipliers within the system. So now we can pick up a comment, for example, that the algo leaves, and then we can then divert it to the correct liquidity provider depending on the nature of the trading strategy, which again was requested by one of our clients. And I think it just shows that the brokers really are looking into their flow now. But it makes it challenging for you because they derive it off the value. A lot of those things, are they at LP Prime, are they automated, or are you still pretty much doing the good old eyeballing of the trades? How do you pick it up?
It's a combination. We have a system, a database, SQL database running all the queries that we have set up. So when there is something, it will pop up, and then we have a look at the information. Now, it cannot be fully automated because the parameters and the way that people trade change every single day. Okay, why? First of all, when someone acts, you have to react. So you are always like a police officer, right? You are running after them. And the more advanced you become, the more clever they become as well. Imagine you have a company, it has, I don't know, 100 people, 200 people. The population of Earth is 7 billion people. So somebody smarter than you are out there. It's inevitable. So they have to act, and then you have to react. So just because this is the norm, we have the parameters in place, and we keep looking at things manually as well, just to confirm the suspicion. Now, if there is something wrong with it, we have conversation with the client, the broker in our case. We say, guys, listen, these are the results of your trading activity. We have to do this and this. We always come up with a solution. Okay. Um, once we've analyzed the data, we'll give you a solution, because let's say that you have a feed that is purely retail, okay, it's for soft flow, and you hit every single time with a sharp flow, then that feed is not good for you. All right, we might have to take it away from you. So we'll give you a solution to accommodate that kind of flow as well, and also your retail flow, so you are happy in both cases. We've been doing it for a year now. We analyze the data, we give you a solution, and then we move forward.
So, as we've been speaking about risk appetite and P&Ls of the brokers, and that potentially some of these, so do I understand correctly that some of these strategies may be flattening the curve, or is it that the broker think they might flatten the curve because there is a mistake in categorization, and in fact they're actually protecting the P&Ls? Like, what's your view on that? Like, do brokers have to flatten the curve in a way?
Well, the thing is, again, we have to go back probability. You see where your PNL is, and you see where your PNL should be. Now, by taking um, actions, frequent actions on it, either by increasing the B booking, either by increasing the A booking, etc. Essentially, you become a trader, right? And research has shown that the active management is much less profitable than the passive management, right? So in that scenario, I would say that check where your P&L is, okay? Understand your expenses as a broker and decide. So now, am I going to protect the company and make sure that I'm going to cover the expenses for the next year or so, or am I going to gamble 1 or 2 months of expenses now? If I end up losing money in the process, am I willing to cover it as a company from a shareholder perspective? And once you've absorbed all the information, then you decide. But to flatten the curve or not, I think the market will do it for you by itself, because at some point the market will be a directional, and the PNL will go down to the spread plus the charge that you apply on addition of the spread. But I wouldn't advise somebody to become tricky with the execution. You don't need to. You don't need to risk your reputation for 1 or 2 months and then end up losing clients, right? Be patient and decide. Now, as the market stands right now, do I have the ability to absorb the losses? Yes or no? Yes. Okay. No, hedge. From the volume that you have, you are going to be generating markups. You know how much the markups will be. You know how much your expenses will be as well. So do the comparison. But don't there is no need to become a nasty broker. It destroys
Now,
everyone, right?
yeah, I really appreciate it. I mean, our industry is under so much scrutiny. We really don't need any more dark PRs or like bad news.
Exactly. Yeah.
So when you look at at the liquidity ecosystem right now, or call it industry, right? What would you say? What kind of liquidity providers are there, and how are they different? And where would you put yourself? Like, how would you categorize yourself?
We are also a prime of prime
Okay.
liquidity provider. There are plenty out there. There is no need to name them. They are all very decent, very, very decent. What I feel right now is that there is a gap between the liquidity providers and the brokers, in the sense that, for example, if you are a true prime of prime, the match requirements that you have with versus with your counterparties are much more stricter than the batch conditions that the CFD providers want to give to their clients, right? And that gap seems to be the most problematic one, because people don't realize that, okay, we cannot offer gold at 1 300 400, right? Because I can hedge with 1 to 100, best case scenario 1 to 200 if I trade with a large provider. In reality, gold is much less than that. So this is the gap that I see now. Now, the liquidity providers try to minimize that gap, but also another gap that exists is the experience when it comes to retail and the institutional business. Okay, us having this experience from both sides, retail and liquid, you can close the gap between us and the clients. But I would say that the biggest challenge now is to make brokers realize that they have to offer realistic conditions to their clients rather than, because they all want to compete for a short portion of the pie by offering, too many things, too much leverage, too low spreads. Pretty much, they want to give everything for free, and when they realize that they cannot handle it and they have to hedge, what they offer does not match the reality, the real world, right? So this is where things stand right now in our industry, I think. But from February, slowly, people started realizing that, okay, maybe we are doing something wrong here. Maybe what we have been doing so far has not been the correct approach. Maybe in the process we have made money, but now is the time to see the other side of the knife. So I can see this gap closing sooner rather than later.
I think it's a difficult one, and I think because both you and we've managed retail brokers. I think it's a very difficult one because you get those traders who come to you and say, "Oh, but all of your competitors are offering this," and then you have to turn around and say, "Look, yes, they do." But you need to understand that a financial firm, it's a business. So the firm needs to be able to make money somehow. And if they're offering this to you, it means they're making money somehow differently somewhere else, using those naughty features, right? Or using those naughty tools or things that shouldn't be used and are not authorized by the regulators to be used, which again is just, and it happens in technology as well when somebody goes and says, "Oh, I found this technology provider," and they say they're going to give me, unlimited makers. And you go, yeah, well, probably they say that. But in reality, once they do that, quarter updates put load on the system, their system is not going to cope. So it's just for free, I mean. So it's just like one of those things that clients in general need to understand that there is no such thing as for free services, I guess.
Exactly. That's
Otherwise,
absolutely right. Yeah. That's
it's a
true. You
decision.
have it as well in that, every day people coming in saying that, oh, but this company does that. It's okay. What can I do? I mean, it has to make sense. A relationship needs to be beneficial for both parties, right? So it has to make sense. It cannot be in one side indeed for you to run your business, but at the same time putting our business at risk, right? Should be mutually beneficial for both parties.
So when you offer certain conditions to your clients, like do you impose strict NLP limits, like margin requirements, things like that, or is it because you said that it's pretty much tailor-made? Is there a precise approach that you use when you define those limits?
We take in the client's needs and we come up with an offer.
Okay.
Now different clients need different requirements. Okay, so yes, somebody might be carrying over positions that are large compared to their balance sheet. So you understand that the match requirements will be tighter for them. Somebody might not be utilizing the leverage so much, so the leverage condition might be better for them. It depends on what they need. Now, if they need to trade heavily with their account, overexposing themselves every single time, then the condition might be stricter compared to somebody else that, they have a number and deposit in their account, but then don't utilize it that much. So in case they need it, there is equity left for them to fund their account. So it's not one approach for all. We take some time, we understand what they need, and then we come up, we return back to them with an offering. So it's an offer that suits their profile. Okay, and also we might split the NOPs across different symbols. We might offer zero NOP for a specific symbol, but the whole NOP will go to one symbol. It depends on what they need. The match requirements, though, there are some symbols that cannot be loose. Okay, exotic pairs, for example, or symbols. You cannot go crazy with this kind of symbols. First of all, we don't get the credits from our clients, from our LPs as well. And second is because the match utilization there is high from our side as well. So we cannot be offering high degree of leverage to those symbols. But for the rest, have a look at what they need and come up with a solution.
Fantastic. So you're sharing your expertise in a way with them and help to work out what works for them.
Yeah, I share some of my magic here.
So I really ask all of our guests about the future outlook. And since you're in liquidity provision and in general in dealing and risk management, how do you think it's going to change? I mean, it's hard to say in the coming years, right? We used to think 5 years, but now I think it's like, you can't say that
Tomorrow.
anymore. Yeah, tomorrow. I
Tomorrow.
was going to take tomorrow.
So it's been an interesting year. Trump came into the office. He started a trade war with pretty much everyone. Then, then deciding that okay, let's relax a little bit. This affected our industry. You know what I feel is that again, it's what I said back. People realize that the conditions offered to the clients need to change. There is nothing for free, despite the fact that there is so much competition. Things started normalizing again. So what I would say, it's a shift of in general offerings from LPs to brokers, and I would say that brokers will become more hybrid in terms of risk management. By what do I mean by that? That they will apply an A and B book model, a C book model, where they will be hedging part of their exposure, will be internalizing part of their exposure. They will be reading more data, more relevant data, rather than, let's start a broker, everyone will lose their money and they will become rich. That's no longer the case. They will become also more sophisticated. So I feel that the industry will become more self-regulated in the sense that yes, you have the directives, either you have European license or whatever, you have all the directives in place, but also the culture and approach of the retail brokers at least is gonna change to what they want to do, what they want to achieve versus what their clients need. Okay, and also it changes. Now you have, for example, I don't know, Revolut, for example. Okay, people can trade from their Revolut instantly. Okay, that's a competition, right? You have one account, you deposit, all of a sudden you can trade and up. So this is something you also need to factor in the equation. So I see that yes, things will normalize, and also the technological advancement is gonna be large, at least in the coming years.
Okay. And what do you see are the hottest trends then in our industry, not just in liquidity or risk management?
I don't know, prop firms.
Still prop firms?
I don't know, they are still popular. The hottest trend. Okay, no, I was joking about the prop. This AI, we are entering to an AI era. Where technology is becoming huge part. It's always been a huge part of our industry, but now it's becoming more and more important, from clients onboarding to retention to conversion to categorization. Now there are crypto payments, you have to analyze them, pass them through an AML monitoring tool. So the AI is becoming more and more relevant in our industry as well. So I would say that technology is gonna make a boom very, very soon in our
Hope it's
industry, at least.
a
Good one,
good boom.
good one. Yeah, good, good one, good, good, yeah.
Hope it's a good boom, not a bad boom. Yeah, I agree. I think what we can do with the tools and computing power that we have access to right now is really fascinating, and we're on the verge of something big. Thank you very much, Marios. I think it's been super insightful, and thank you. Where can people reach you? LinkedIn, LinkedIn, email,
LinkedIn,
website.
email, I don't know, WhatsApp, Telegram, whatever.
You're
I'm always
open to
available.
communicate. Fantastic. All right. I need to say share, like, and subscribe, and
Absolutely, yeah.
stay tuned. Thank you so much, Marius.
Thank you, thank you.